In this video, we are going to discuss the concept of temporary difference, and also we are going to discuss how a temporary difference creates a deferred tax asset or a deferred tax liability. So the temporary difference arises when an expense is allowed for both tax and accounting purpose, but the timing of the allowance differs. So it requires an example to understand. So for example, let's say the X Limited purchased the fixed asset for $60,000. The useful life of the asset is expected to be 5 years. So in the books of the X Limited is using straight line method of depreciation, whereas in the books of the tax authority is using accelerated method of depreciation. So under straight line method of depreciation, the same amount of depreciation will be charged over the useful life of the asset. So here it is 60,000 is the cost of the asset. The useful life is 5 years. So at 60,000 by 5 is 12,000. So depreciation expense of 12,000 is charged over the 5 years period time. Whereas in the tax book, the tax authority is using accelerated method of depreciation. That is, and in accelerated method of depreciation, higher amount of depreciation will be charged in the initial years and a lower amount of depreciation will be charged in the subsequent years. So when you look carefully, the total of book depreciation is also 60,000 and the total of tax depreciation is also 60,000. But the way in which the 60,000 is apportioned, the way in which the 60,000 is distributed over the useful life of the asset is different. And that creates a temporary difference of $8,000 in the first year and $4,000 in the second year. And in the third year, there is no temporary difference because the book depreciation and the tax depreciation are equal. So there is no temporary difference. And a temporary difference of negative 4,000 is created in the fourth year. And a temporary difference of negative 8,000 is created in the fifth year. And here it is said that the temporary differences reverse. So when you look carefully here, there is a temporary difference of 8,000 in the first year. And it is reversed in the fifth year. So here it is positive 8,000 and here it is negative 8,000. So it's netted off. And in the second year, there is a temporary difference of 4,000. Whereas in the fourth year, there is a temporary difference of negative 4,000. So it's netted off. So at the end of the fifth year, the total of the temporary difference will be 0. Now let's see how this temporary difference creates a deferred tax asset or a deferred tax liability. So this accounting book is the book prepared by the entity. It's a financial statement prepared by X Limited here in this case. So in the accounting book, in the first year, a less amount of depreciation is charged. So here it is 12,000, whereas in the tax book it is 20,000. So in the accounting book, a less amount of depreciation is charged. So less depreciation means more accounting profit. More accounting profit. So more accounting profit means more tax. If you're earning more profit, then you will have to pay more tax. It's quite simple. And in the tax book, they are charging higher amount of depreciation because here it is 20,000. Here it is only 12,000. So a higher amount of depreciation is charged in the more depreciation. Higher amount of depreciation is charged in the tax book. So more depreciation means less taxable profit. And less taxable profit means less tax. So according to IFRS, X Limited is estimating that it will pay a tax of, let's say, $10. Whereas the tax authority wants X Limited to pay a tax of only, let's say, $8. So there is a difference of $2 here. Here there is a difference of $2. And what is this $2? Is X Limited actually saving tax here by paying less amount of tax because they estimated to pay $10, but they are paying only $8. So is this $2 a savings of tax by X Limited? No. This $2 is the deferred tax liability, which will be paid in the future. It's a deferred tax liability because in future, X Limited will be liable to pay this $2. So there is an obligation for X Limited to pay this $2. So this $2 is a deferred tax liability. And here X Limited is not saving any tax, but they are just deferring it. Deferring it in the sense they are just pushing it towards the future. So this $2 will be paid in the future. So in the second year also, you will record a deferred tax liability, because see, whenever the accounting profit is greater than the taxable profit, you need to record a deferred tax liability. In the second year also, the accounting profit will be greater than the taxable profit, because less depreciation is charged in the accounting books as compared to the tax book. So whenever the accounting profit is more than the taxable profit, then you need to charge a deferred tax liability. And in the first year, a deferred tax liability of $2 will be recorded. Whereas in the third year, no deferred tax asset, no deferred tax liability, because there is no temporary difference. So if there is no temporary difference, no deferred tax asset, no deferred tax liability will be recorded. Whereas in the fourth year, it's different. See, in the fourth year, the accounting book, they have charged more depreciation. Here, 12,000 is greater than 8,000. So the accounting book, there is a more depreciation. And more depreciation means less accounting profit. More depreciation means less accounting profit, and less accounting profit means less tax. Whereas in the tax book, they have charged less depreciation, and less depreciation means more taxable profit, and more taxable profit means more tax. So in this case, for example, according to IFRS, X Limited is estimating to pay a tax of, let's say, $10. $10. But the tax authority might want X Limited to pay a tax of, let's say, $12. So here we estimated to pay a tax of $10, but we are paying a tax of $12. So we are paying in advance, like we are paying in advance in the sense. So there is a difference of $2, and this $2 is the deferred tax asset here, because we estimate we are supposed to pay $10 this year, but we are paying $12. So there is a $2 which is paid in advance. So it is a deferred tax asset, because in future you will pay less amount of tax, or in other words, you can recover this $2 in the future. So you can recover this $2 in the future. So it's a deferred tax asset. So similarly, in the fifth year also, you will record a deferred tax asset, because the accounting profit will be less than the taxable profit. So whenever the accounting profit is less than taxable profit, you need to record a deferred tax asset. And whenever the accounting profit is greater than the taxable profit, you need to record a deferred tax liability. So in the first year, a deferred tax liability will be recorded, because accounting profit is greater than taxable profit. So in the first 2 years, deferred tax liability will be recorded. The third year, no deferred tax asset, no deferred tax liability. Whereas in the fourth year, a deferred tax asset will be recorded, because the accounting profit is less than the taxable profit. In fifth year also, a deferred tax asset will be recorded, because your accounting profit will be lower than your taxable profit.